Ladies and gentlemen, on today's video, this is gonna be a big one. This may be controversial. Some people are not gonna like this video, and that's okay. I promise to do my best to tell you the truth as I understand it the best I can. With that being said, nothing in this video is financial advice. I'm not a financial advisor. I'm just a cryptocurrency enthusiast. And as a hobby, I like to pay attention to the macroeconomics. That's what led me into investing in Bitcoin originally in 2017. That's what caused me to follow Bitcoin prices all the way back when Bitcoin was trading at $300 each, and it was almost impossible to be able to buy it. There was no good centralized mechanism back then to be able to buy Bitcoin. Back then, you had to download the full blockchain on your computer, and you had to use what's called a paper wallet to be able to access cryptocurrency all the way back then. But it was understanding the macroeconomics where I understood why Bitcoin was created. Originally, I didn't understand if Bitcoin could work, but after a while, recognizing this was in fact functioning well and recognizing that it became easier and easier to actually purchase Bitcoin, I started making my first crypto investments in 2017. That brings us to today. Because a lot of what's happening right now is going to affect the macroeconomics, and not a lot of people are talking about this. And I see a lot of people sort of candy coating it, and they're kind of being they're sort of being really positive, or they leave you with an uncertain feeling. I saw some big crypto YouTubers saying things like, "We don't know what this means for the future, or the next few weeks or the next few months will be interesting." And the reason they do that is because it's really not popular to sometimes speak in a definitive when there's negative news. So your audience doesn't like negative news, generally speaking, and it can hurt your subscribers. But listen, I promise you, my intention is not to be more negative than necessary in any way, shape, or form. I think there is some positive lining here. I think there is a silver lining. However, I think we have to be aware as individual investors. We are responsible for our finances and our family. And at the end of the day, the government's not going to protect you or me before they protect the big banks and the big businesses, which give them campaign contributions. Far more campaign contributions than we could ever give them as individuals. So let's take a look at what's happening here. Let's take a look at why it's happening. Let's break all this down. And towards the end of the video, I'm going to share with you, again, not financial advice for you, but I'm going to share with you specifically the steps I have been taking and am currently definitely taking for myself and my family to help protect my family. Because, ladies and gentlemen, here's what I can tell you. Anytime there's a difficult time or a crisis, the people who can survive the best, not everybody's going to escape the uncomfortableness. We all may get a little bit more uncomfortable, but the people who can survive the best are the ones who are most able to seize opportunity in the future. And being able to seize opportunity is where true wealth is made. All right, let's go ahead and get started. So what caused Silicon Valley Bank's failure? So there's an article here that's explaining it really, really well. It's over here on Reuters. I'll try to remember to put it down in the description, but let me just say this. Essentially, what has happened back when COVID, remember when everybody in the US and really around the world, government started giving out stimulus money and stimulus checks? Well, early on, I mean, my accountant, for example, was like, this is a bad idea. Like, this is horrible economically long term. We ended up getting these $600 checks, and people got money if they had kids, and if you had a business you got even more money, and they weren't even tracking it, they weren't even monitoring it. I saw a whole documentary about a business and several individuals who opened up several businesses and ended up getting, I want to say it was like $15 million in all, basically scamming the government. Well, they got caught for that, but the vast majority of people didn't get caught. You didn't have to get caught. I personally know a business that tried to pay back a $15,000 loan they did not need. They tried to pay it back. And the payback button on the website that processed the payouts and supposed to process the paybacks, the payback button did not actually work. They had to reach out to customer support, escalate it to management. Management took 2 days to get the button working on the website, and then in a phone conversation asked, "Why are you trying to pay this back? We've literally had nobody try to pay this money back." And it was supposed to, quote unquote, be a loan. Because of that loose financial policy out of government's desperations to try to, quote unquote, help, if that's what they were doing, what's ended up happening is inflation is running rampant. That's why prices are so high in the grocery store right now, for example. Because inflation is high, there's only two ways to take money out of the system to bring inflation down. One is to raise interest rates, how much it costs to borrow money. The other is to be able to raise taxes, which our government is looking to do both. They've been raising interest rates. Now, one of the side effects of raising interest rates, there's a lot of side effects, but one of them is that banks oftentimes take your money because your money's getting, keep in mind, your money is getting devalued every year through inflation. Inflation is supposed to be around 2% a year. It's been around 8% currently. So your bank will take that money that you put on deposit and they will use it to buy treasury yields or mortgage-backed securities. These securities pay a fixed interest rate over a set period of time. Silicon Valley Bank had $80 billion under management. Think about that. $80 billion under management. However, because they had a lot of this money in treasury securities and the government was raising interest rates, it made new treasury securities more valuable. In other words, let me break it down for you this way. If I sold you a $10 bond and I told you I would pay you 2% a year for the next X so many years, and then you wanted to liquidate that bond, so you wanted to sell it to somebody else. But when you went to sell that bond, $10 bonds were now paying 8% a year. Do you think they're going to pay you what you paid for that $10 bond when you bought it? And when they can currently buy a bond that's paying 8%? No, you're going to have to sell it at some sort of a discount. So Silicon Valley was having to sell bonds to raise money. They took a loss on that bond sale of, I think, $1.8 billion, if I remember. Then they said they were going to sell some stock to be able to meet that shortfall. By the way, this was all part of doing business. This was all, at this point in time, we were all still within their risk exposure. They understood they may have to do this. And it literally would not have been a big deal if they didn't lose $1.8 billion on the bond sale. That made it look a little bit desperate. Silicon Valley Bank did not deal with individual investors. They dealt mostly with venture capitalists and venture capital firms and individual startup companies. Several of these large venture capitalists realized, hey, they just sold their bond business to raise money. And not only did they sell it, they sold it at a $1.8 billion loss, which means they had to sell it quick. Oh, look, now they're saying they're going to sell stock too. So everybody's concerned, does this mean they're out of money? Well, we all know all banks are basically out of money. And the whole illustration looked pretty desperate. So these venture capitalist firms told their businesses they had invested in, hey, it might not be a bad idea to withdraw some money from Silicon Valley Bank. I saw one note that said there's no downside to withdrawing money out of Silicon Valley Bank. Well, when you suddenly get a windfall of millions of dollars being requested from withdrawals, it creates a run on the banks because the bank doesn't have cash. Now, here's what's interesting. Was Silicon Bank out of money? Well, they were out of money today. They were bringing in enough revenue to cover their day-to-day expenses under normal circumstances. It's when there's a panic, they couldn't cover the panic. And so now essentially they have failed. And then there's another bank, First Republic. First Republic Bank services the wine industry. The wine industry, people are concerned, oh no, this happened to Silicon Valley Bank. Is this going to happen to First Republic Bank? And people started withdrawing there. The California government came in and shut down First Republic Bank on Friday. I think it was to try to stop withdrawals, to basically give it a cool off. So imagine all of a sudden your bank is shut. Now you can't get your money out. That's crazy. And then we got, of course, we previously had Silvergate Bank, and then come along Signature Bank, number 2 biggest bank for fiat crypto on and off ramp, by the way. So now we got Signature Bank coming in, and all of a sudden the government stops them because it looks like they're not going to be able to be financially sound. Ladies and gentlemen, now people are saying, oh, crypto prices are going up. This is proof that people are running from banking and they're running to decentralization. This is one of the first statements I'm going to say that is unpopular, but hear me out. I disagree with that wholeheartedly. I don't think people are running to decentralization. Because the government has agreed to come in and backstop the depositors, that means there's going to be basically free money. Everything's going to be okay for the time being. Anytime the government says they're going to print money, just like when the government says they're going to cut interest rates, anytime that happens, people feel like they have a higher risk appetite and they rush into assets. Crypto benefits more than a lot of other assets. If you're familiar with the crypto market, you buy Bitcoin when the government says they're going to start printing money. You buy Bitcoin, you buy Ethereum, you buy BNB, whatever. You buy USDC. That's kind of a joke. But you buy these crypto assets that are going to go up in value. Listen, Bitcoin and Ethereum just lost two major off ramps, meaning it's actually going to be more challenging than ever to be able to get your crypto off and into fiat. It doesn't mean you can't, but it does mean if you have millions and millions of dollars, it's going to be a much more significant challenge to move that crypto off. Now, people are like, yes, but there's Coinbase that uses a different company, and there's other companies that use different companies. Listen, here's what you need to understand. There are going to be no new on-ramps for crypto no time soon. Why? Because we have unclear regulations coming. Nobody's rushing to create a new on-ramp right now for crypto. Nobody. Why? Because they don't want to be considered to be some sort of securities dealer once the government decides which crypto is a security and which one's not. They don't want to take that financial risk, that business risk. So the bottom line is we have less on-ramps and off-ramps. That's not a positive thing for crypto. The prices are going up not because people rush into decentralization. The prices are going up because right now money's free and money's cheap. And by the way, that's a good thing. I'm a hodler just like you. That's a good thing for my US dollar value of my crypto. Of course, that's awesome. But we just have to be aware of what's actually going on here. This isn't a rush to decentralization. If they said we're not going to step up and help these banks, if that's what they said, then my question is, would we see Bitcoin going down or up? I think we'd see it going down. Because why? People would try to liquidate. They would try to free up cash. They got money. Many of these large tech firms and crypto firms have got money stuck that they can't get access to. They need that money. So I think they would start selling crypto assets in that case. And I believe that flies in the face of people rushing to DeFi. I wish they were all rushing to decentralized finance, but I don't think that's what's happening yet. But this continues to unfold a bit further. I shared this, retweeted this from Eric Voorhees on Twitter. The primary reason for the failure of Silicon Valley Bank was their choice to invest their customers' deposits in treasury bonds. This point doesn't get enough attention. The issue here is all banks invest in treasury bonds and mortgage-backed security. When you deposit money, they put that money to work. Well, the safest place to put your money is in treasury bonds. There's estimates, there's over $640 billion losses on national banks' books right now, on banks around the U.S. $640 billion in paper losses, meaning they can't sell their treasury bonds. Meaning if people try to withdraw money, they're not going to be able to get it. And if they sell the treasury bonds, they're going to take a loss just like Silicon Valley Bank did. This is very interesting. This just highlights kind of the weirdness going on. Jason Brent retweeted this, just doing some relaxed weekend reading and noticed a press release on the systemic risk exemptions for depositors at SVB and Signature Bank points to the board votes taken by the Fed. The proximity to other votes is unbelievably epic. So here's what he's talking about right here. Invoking systemic risk exception for Silicon Valley Bank and Signature Bank. Who voted against it? Nobody. Who abstained? Nobody. So the board took action. Now, this is weird. Federal Reserve Board announces it has denied the request of Custodial Bank on its application to be supervised by the Federal Reserve. So let's take a look at what Custodial Bank is. So this is the Custodial Bank website. Couple things to take a look here. Now, keep in mind, the Fed just agreed to bail out two banks that did not have enough reserve capital on hand to meet deposits. Why? Because they're doing fractional reserve banking, where they can lend out deposits, right? And they can use deposits to buy treasury bonds and mortgage-backed securities. So Custodia. So this is a bank that is looking to serve digital asset clients, i.e., cryptocurrency clients. Here's what makes them unique as a digital banking client. Demand deposit accounts protected under 100% reserve requirement. So they are saying we will have every asset backed 100% by reserves. I'm not certain if there's another bank, period, in the US that can say they have a 100% reserve requirement. Most banks under fractional reserve lending, it's a 10% reserve requirement. They're saying a 100% reserve requirement. So now we come back over here and a 100% reserve requirement bank gets denied by the Federal Reserve for their oversight and the benefits of the Federal Reserve System. But two fractional reserve banks who essentially failed ended up getting bailed out. That's crazy if you stop and think about it. What does all this actually mean? Well, let's go a step further. Some of you may know that Fed Now is coming. And I'm not telling you this to necessarily build up a full case. I'm just showing you where there's some uncertainty in the future. And then I'm going to talk about how I'm navigating this for myself and my family. Because at the end of the day, it's up to us to take responsibility for ourselves and our families. So Fed Now is on the way. It's going to get released mid-2023. Many of you are aware that right now the way dollar transactions exist in the banking system is very antiquated. It goes through ACH transactions and wire transactions, and that can take several hours, in many cases, even several days for a transaction to actually clear. Fed Now is going to allow instant payments 24/7 through the federal banking system. This is the whole new thing they're coming out with that's going to launch. Now, interesting fact, central bank digital currency, they're going to be 2/3 of the way there when they launch Fed Now. The only thing they need to do is connect a digital ID to your Fed Now account. And they essentially can issue a central bank digital currency right then. And obviously, they almost have digital IDs completed here in the States as well. Sticking to the central bank digital currency, one common misconception is that that's going to be a blockchain currency. There is no guarantee that's going to be a blockchain currency at all. In fact, the latest proposals have been that it will not be a blockchain currency. It will just simply be a digital denomination of a nominal value tracked by the Federal Reserve banking system. In other words, dashboard money, play money, nothing real hard assets backing it up. You have those dollars because they say you have those dollars essentially. That's very interesting. But here's what you need to know for today's video. Fed Now is going to require or is going to allow instant withdrawals. Why is this a big deal? Because the way the federal government was able to step in with Signature is because they could look at pending withdrawals. They could see funds moving and they could realize that Signature Bank is going to become insolvent. The reason you can see this is because it takes several days for ACH transactions and wire transactions. Fed Now is going to allow you or a business to withdraw money up to $100,000 transaction instantly. That means banks have to keep more funds on hand because it's easier to have a run on the bank. So they're supposed to keep more funds on hand. That's what a lot of people are saying. It's very difficult for small banks to be able to keep those funds on hand in most cases because the way banks make money is through lending their money out that you deposit. So since they're not going to be able to lend as much, even under the fractional reserve rules, it's going to be challenging for small banks, local banks, mom and pop type banks. It's going to be harder and harder for those banks to even exist or start because the capital requirement to keep on the books is going to be much higher. The profitability is going to be a lot lower. So we're moving towards a system where it's going to be big banks only. And again, big banks typically are embedded with the government. The government steps in, take over banking operations. There's been a big push for a long time for a totally Fed banking system. I don't think long term that helps the consumer at all, but we're definitely getting closer and closer to that right now. The Fed is rewiring the U.S. payment system. Here's what you need to know. Here's what that means to you. I'll try to put this link down in the description, but this is talking about Fed Now. Also, this is important. So the Fed decides they're going to bail out banks. They're going to step in and help depositors, basically. I shouldn't say bail out banks. They're going to bail out the depositors. Bank Term Funding Program is big enough to cover all U.S. uninsured depositors. So they're coming out with this Bank Term Funding Program. And they're doing this to let depositors know, hey, you don't have to go get your money from the bank. It's going to be there if you want to get it. The U.S. government is going to make certain it's there. Why? Because we're going to be able to print money and give you. Talk about uncertainty. This is interesting. This is essentially quantitative easing. If people want to start withdrawing their funds, then the Fed is saying, we'll cover deposits. So this way, banks don't have to sell off their bonds. And since they don't have to sell off their bonds on the secondary market and take a loss, we'll cover the depositors. They can basically just borrow unlimited amounts of money from the government to cover any depositor withdrawals. This essentially just puts more dollars in the system, but it also increases the speed of inflation. Now the question comes down, so is the Fed going to raise interest rates? When they meet, are they going to continue to raise interest rates? Right now, the Fed, they have two mandates. One is to try to keep inflation at 2% and keep employment above 4%. The last employment number, I believe, was 3.6%. So employment is below 4% right now. So arguably, they can raise interest rates. Some people are saying they're not going to. I actually think they will raise interest rates. But this is going to put a lot of smaller banks at continued risk. And some people are predicting that's not going to happen because they don't want to see banks fail. But I would argue that the federal government doesn't have anything to lose by coming in and helping banks with the bank term funding program. If anything, they end up getting more control over the banking system at the end of the day. Now imagine, think about any of the finances the government has ever had control over. Think about Social Security, for example. In the US, they have control over Social Security. Originally, the way they did that was they voted, I think it was in the 50s, for Social Security to be created to help older people and elderly people supplement retirement. Some people were against Social Security, some people were for it. The way the Social Security law passed is the federal government said, hey, we were going to write this law for Social Security, we're going to write a second law that will say Social Security will be held in a segregated account. Then you don't have to worry about the government messing with it. So it narrowly got through, it narrowly got voted on, it became law. A few years later, the federal government came along and passed a law. They attached it to another unrelated bill and basically said the government can access the funds of of Social Security. They just have to pay them back with no term to pay those funds back. Today, Social Security is broke because of this. I see the federal government stepping into banking as potentially giving the federal government access to a lot of people's funds, essentially, acting as a direct bank, basically taking custody of assets, but knowing that it's okay, they're always going to be there because the Fed can always print more money. I don't see this as positive for the individual long term personally. Inflation is going to speed up and risk hyperinflation. That's kind of what I see going on right now. From a macroeconomic perspective, this puts the world reserve currency, the US dollar, at risk. Right now, the dollar does well against other currencies because the dollar's least bad or the most creditworthy because other countries are printing money faster than the US dollar. But countries like Saudi Arabia are looking to get away from the US dollar. At least they're discussing it openly. Now, many people don't realize this, but the U.S. government and Saudi Arabia have a very close relationship. That's why you don't ever hear about you'll hear about how bad Iran is on human rights. Sometimes you hear how bad China is on human rights. You'll hear how bad Iraq treats women. You'll hear how bad Iran treats women, but you almost never hear how bad Saudi Arabia treats women. You never hear about that in the American press. And part of this is because we don't want to mess up that relationship with Saudi Arabia. Saudi Arabia has agreed as long as we buy a significant percentage of our oil directly from Saudi Arabia and or OPEC, and as long as we're their military defense, then they will always sell oil in dollars. And when that arrangement was made, it was good. The dollar was strong. America's place in the world was pretty secure. They were currently the number one financial empire, so to speak, or however you want to say it. They were the strongest, government, and the currency was the strongest at the time. But over time, people are noticing there's cracks. I mean, most American citizens will see there's cracks in the economy, and these cracks get a little bit deeper and a little bit deeper. Listen, 2-3 weeks ago, nobody would have predicted that there was going to be a bank collapse in the U.S., much less 4 in a weekend. There is a possibility of other countries diverting away from the U.S. dollar. That puts the U.S. governments on shaky grounds with what they can continue to do, how much debt they can continue to go in, how many more dollars they can continue to print. I'm not predicting gloom and doom. I don't know that we're going to suddenly lose the dollar as the world reserve currency. I do think we're moving towards that trend. I do think that is most likely at some point in the future, but I don't know if we're talking about 5 years, 15 years, or 25 years. But clearly that's the trend that we're on as of today. So what does this mean for individual investors? Well, it just means a lot of uncertainty, and let me tell you how. Interest rates will if I had to guess, interest rates are going to get raised the next time around. And I can do a whole video on why I think that's going to happen just to see if it happens, but interest rates are probably going to get raised. Borrowing is going to be more difficult. Any variable interest loans, if you have them, minimum payments are going to go up. Now, by the way, as interest rates go up, the unemployment could potentially go up as well. That's one of the challenges that the federal government has. Smaller banks may collapse. We may see more bank collapses coming, but the federal government is saying, don't worry, your money's going to be there. Is your money safe? Are you going to be able to get to it when you want to? Listen, you have to decide that. But amid all this uncertainty, I'm going to give you sort of a general overview of my finances. And it's very simple. I always think about worst case scenario, 30, 60, 90 days, 6 months, 1 year, 5 years, 10 years. I look at those kind of arbitrary time frames, even 20 years. Here's the thing, 30, 60, 90 days, what's most important? Is my Bitcoin the most important thing? Meaning if I need money in 30 days, is my Bitcoin the most important thing? Can I get my Bitcoin? There's a lot of things that has to happen. If I go to stablecoin, I got to know my stablecoin is safe. That's a risk currently that we have in the US. I got to know that the exchange I'm using is also going to be safe. I got to know that if the exchange transfers to a bank account, that bank account's going to be safe. And I got to know that I can easily access those funds out of that bank account. So there's 4 vectors of risk I got to be aware of. The other thing is cash in the bank. And then your only risk is, can I get to that cash? But if you have cash on hand, you don't have to worry about it at all. So short term, 30 days, 60 days, 90 days, I think it's smart to have cash on hand. Now, I talked about some of this over the weekend to those of you that are subscribed to my email newsletter. Actually, I sent it first to my copy trading subscribers. If you go down in the description, I'll put my email list on copy trading down in the description, where you can follow my journey from $500 to $5,000 a month. Go down in the description and subscribe to that. But I sent that out to them and I said, hey, I don't see much downside to having some cash on hand. And one of my subscribers wrote me back and said, yeah, but what about your security risk? Well, first of all, you don't advertise how much you have. And they were like, I don't think that's a good idea. You can't earn interest. Well, what am I earning sitting in my bank account liquid? And are the risk worth me earning 5% a year even if it's money that I need to get access to immediately? You understand, if SVB depositors did not get bailed out, there's a whole bunch of people, like employees of Roku for one, would not be getting a paycheck. So you got to make certain that the bank you bank with and the bank that the company who pays you banks with is not going to run into any issues whatsoever. And I don't know in this current environment where we see things headed with if interest rates continue to go up, knowing that a bunch of banks have paper losses on their books. I don't know that I want to keep my money I need today to pay the bills and to buy groceries. I don't know that I want that at risk, no matter the interest rate. That's not money I'm worried about earning a big interest on. 30, 60, 90 days, have some cash. Another 30, 60, 90 days need to be just sitting in your bank account. Yes, you're not earning interest on it, but it needs to be there. You need to have access to it. Ladies and gentlemen, I know we're talking about up to 6 months or even a year here. Look, Wealth, I don't even have money for next week. Okay, that's fine. Start with $50. Pull out $25. It's hard to go wrong having cash on hand. It's just hard to meet your immediate needs. Start somewhere. Then when it comes to cryptocurrency, it's hard to say hold your funds in a stable coin, because so many have risk to regulations. I think the best place, if you're going to be in crypto, not financial advice, but probably just holding Bitcoin. If you had to hold it somewhere, just hold it in Bitcoin. But we know that's not a perfect answer, because Bitcoin's really, really volatile as well. After that, after having, but assuming you have 30, 60, 90 days in cash, 30, 60, 90 days in a bank account you can easily access, you want to be diversified across your other investments. I had a gentleman reach out to me personally, and he said, listen, I'm at retirement age. I got several $100,000. What do I do? All this uncertainty. And I said, you have to diversify. He said, diversify on what? Everything. Do you got some dividends? First of all, do you got cash on hand? Do you got some dividend stocks? Do you got some exposure to real estate, like actual real estate? And if you're in crypto, then of course some exposure to crypto. Diversify across crypto projects. I like to focus on passive income strategies. I focus on earning passive income multiple different ways. Why? Because one of my copy traders got hit hard. One of my 2 trading strategies outside of copy trading, one is selling options. I got hit hard on one of those. Now I got some bot trading strategies. One of my settings, that strategy worked really, really well because it does well in volatility. No matter how you're earning passive income, what you're doing, no matter where your crypto investments are at, your traditional investments, as well as any real estate, ladies and gentlemen, you have to be diversified because we don't know where the uncertainty is. But you want to make certain that you know how you can get access to your funds. That's key. So having some cash on hand, or at the very least, having some cash sitting in a bank account that you're not spending. It is sitting there for the crap hits the fan, so to speak. That needs to be a part of your security plan. Period. End of story. Don't use that money to go into crypto, to go into that, new DApp that's supposed to be paying a high return, or that new altcoin that is supposed to 10x. Again, you're only talking about a small amount of money to cover your family's needs in the short term, 30 days, 2 weeks. We are headed towards time where inflation could be picking up. The government is definitely stepping in to help banks, and their decisions are inflationary. And if they keep stepping in to help banks, the government's going to possibly be a part owner in some of these banks. It gets interesting. Large corporations are going to be looked out for first. They're the ones donating. And by the way, I'm not against corporations. I'm a capitalist to my core, a true free market capitalist, not crony capitalism, where big companies get to control everything just because they can manipulate politics. And that's what we have right now. Large companies manipulate politics. And therefore, the politicians are going to look out for their biggest campaign donors first. So we can't expect the government to bail us out. A lot of people will be begging for the government's help. And if they help us, great. But at the end of the day, we have to be able to protect ourselves. And that's why many of us got started in crypto in the first place. So yeah, I know prices are skyrocketing. And the narrative is this is because people are fleeing to cryptocurrency and somehow mass adoption is going to be right around the corner. Ladies and gentlemen, I'm looking forward to mass adoption. I don't think we're there yet. I think this is a sign of free fiat dollars flowing into the system. Let me know your thoughts down in the comments. Be careful. From one human to another, I want you to take care of your family. I want you to be safe. Decentralized cryptocurrency truly does offer freedom, but I think they're going to do everything they can to stop decentralization. That is my opinion. I create content on YouTube because I want to create awareness. And if you appreciate that, do me a favor and smash that like button. Oh yeah, be sure to subscribe. This is Crypto Wealth. I'm out.